Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, September 8th, 2025. It's 4:23 p.m., so the markets are now closed. I'm going to do just a quick overview, quick closing update on the markets, and just continue to reiterate, as I mentioned this morning, there's really nothing much on the economic calendar today and tomorrow. You can see you don't have any red stars, but you do have PPI. On Wednesday, Fed's preferred inflation gauge. You also have CPI there and jobless claims, things the markets are very much watching right there. For those of you in the nat gas trade, just keep in mind every week on Thursday you get the inventory reports, just like you get the crude weekly report on Wednesday. So you can find that on the economic calendar. So again, markets as expected just going to grind around most likely, barring any other unforeseen news headlines that come out. I just don't see a lot moving the markets much either way, and we had a pretty much flattish day today. What I want to do for you in this video is go over the 11 sectors in the S&P 500. So today I updated my hold weightings on my charts. I have a watch list, if you will, of the 11 sectors of the S&P 500, and I just updated. It was about a year ago since I did. As you can see here, you can go to SPY's website, the Spiders Trust, which I mentioned it's the S&P 500. It's the SPY, the tracking ETF, but you can see they're the same. This is 33.43 now in tech. Versus the S&P at 33.43. You can see, in other words, the SPY does almost a perfect job of tracking mirroring the S&P 500, and you can see information technology. What I noticed as I updated these numbers from on my charts where I had them a year ago is the top sectors have actually all grown by about 1% or more, including tech, financials, consumer discretion. Actually, we leapfrogged. Healthcare we had financials number 2. Healthcare down, has now been bumped down from the third largest, and everything with tech in it. Remember, consumer discretionary, you have a lot of tech-ish companies you'll see in a second, consumer services. And so the things with the Mag 7, Mag 8, 9, 10, whatever you want to call them, stocks, tech stocks or Amazon's considered as consumer discretionary. It's in that sector. In communication services is your Meta and I believe Alphabet, even though of course they're tech companies, but they do a lot of, that's where they fall into that niche. And so you've seen the divergence, if you will, or the concentration more so in the markets, both the NASDAQ, of course, which is more tech heavy, and the S&P increase due to what we all know. It's fewer and fewer companies doing the heavy lifting, a lot of stocks still trading below their 200-day moving averages, and then just a handful of those Mag 10s just continue to outweight, and the S&P has not rebalanced that out. So what happens, it works well in a rising, as long as the that vicious cycle, if you will, or positive feedback loop of more money being spent on AI from Alphabet, Meta, Microsoft, more money going to NVIDIA, and again, it's just keeping that that thing going. When that trade reverses and it goes the other way, and those big companies, once they, when they finally aren't seeing the return on investment on their AI spending and they cut back, it's going to have, reverse the flows on NVIDIA and everything else there. So, and then these guys actually ticked down. Like energy was 3 point something. It's now less than 3%. So a lot of decreases down there in the smaller things. So that's the makeup of the S&P 500. Before I get to those 11 sectors, because that's what I want to do in the rest of this video, is just go through and show you the technical posture, the way I see it on those 11 sectors of the S&P 500. And as I say, an index is simply a sum of its parts. So we could either look at all 500 stocks in the S&P 500. Nobody wants to hear me talk for 4 hours on covering 500 charts. Or we can look at the 11 sectors. That's what we're going to do today. It shouldn't take long. This is the QQQ 60-minute chart. Somebody mentioned, thank you for pointing that out. I forgot to include that in the first post this morning, but I did follow up and posted that chart, inserted it back into the post, and also in the comment section below. So another day where they that suggested stop again. Like I said, we're just going to grind around. Your call whether you want to loosen up stops, assuming you took it. And again, where you took it. It's just a suggested stop based on the initial injury point and if and only if targeting these targets. But again, I believe I mentioned on Friday, if that T5 level is hit, and I will almost certainly be adding additional targets even if we start to approach it, based on what that's going to have done at the time to the daily and weekly charts. But if you're just looking out here and going to this T5, you have about a better than, I believe, a 6-to-1 RR if you took the initial short entry, which was right here on that first back test of the downtrend line, meaning you have 6 units of profit potential versus 1 unit of loss if stopped out. And so far, again, well placed because this was an intraday breach this morning. Friday. That was Friday. That all got faded. They tried it again and parked below it. So it's still, yet the NASDAQ 100 has yet to close above 580. And what I'm going to do right now for you is just add. Before I add it, let me just show you what's happened. This is the trend line I gave you last week, and we had a breakdown. We hit my this first support level I had there, 571.59. Bounced off. It was decent, minor support. Bounced, made a back test, and followed by a rejection off the back test, again, of that trend line. That's how it works. Sometimes you break down, there's the uptrend line, break down, hit the first support level, bounced as expected, a little higher than I expected, but nothing much still, and now a rejection. So the way it works is that support, and needs to be taken out to open the door to this next support, 567. T1's already been hit, giving anybody the chance, if they wanted to cycle out, take profits, game the bounce, get back in. And when T2, if and when gets taken out, that increases the odds. I'm sorry, when T1, 580, about 559 or so gets taken out, that should increase the odds there. So what I'm going to do here is just add, because I can see now we've formed another uptrend line below, coming off the recent lows with a couple reactions there. Probably put it like that, something-ish. So to be continued tomorrow, and mainly, once again, on the economic calendar. Let me go back to that. Where was I? Oh, you saw it. These are, again, not a whole lot on the calendar, really much that's going to move the markets, unless, no, that's only a 3-year note auction. We don't have any long bonds, 10 or 20 or 30-year bonds being auctioned, so that sometimes can rattle the markets. Okay, let's jump into the charts. All right. Once again, there are 11 sectors in the S&P 500, the largest of which has increased at least a percentage point from where I had it last year, and it is now over 33%, 1/3 of the entire performance of the S&P, and again, much more than NASDAQ 100 is attributed solely to the tech sector, information tech. And you can see, as mentioned recently, we put in a divergent high, the first divergent high, nice, clean, negative divergence. First divergent high since earlier this year, the end of, what was that, late February or whatever, and we all know what happened after that divergent high. And as then, we've been building that divergence, and it didn't matter until it did matter. Kind of my yogiism. Those things don't always play out, but much more often than not, that's all we can do here is talk in probabilities, not possibilities. And the probabilities are when you get these negative divergences, overbought conditions, especially after an extended uptrend, the probability of a trend change is likely. That's what it indicates. Momentum is waning, and then you need that magic little spark we call a catalyst, such as a technical breakdown. From this, I think the level that'll do the trick here on the tech sector, XLK, is the support about 256 and change. We'll call it 256 if you want to be safe. So that's that. Again, keep in mind as I go through this, if you want to stop the video after the first three, the rest don't really matter because, again, it's mathematical weighting. If the S&P goes down, it's a near certainty that NASDAQ's going to go down. NASDAQ just goes up and down a little bit more each way typically than the more diversified S&P 500 because the NASDAQ's just more concentrated in those high growth tech companies. So that's that. There's the outlook for X or the technical posture for XLK. When I go to the long-term weekly chart, nothing has changed. The same divergence that was in place last year when we had that first correction and the even bigger one heading into this year that was divergent high 1, 2, 3. It's all still the same big divergence that's been building for a long time here. And if you look closely here, you can see, let me zoom in on this PPO right here. And remember, I'll spend more time on XLK because it is the market. If tech breaks, everything breaks. There's no arguing that. Again, it's just the psychological importance of those big tech companies, including NVIDIA, as well as the mathematical weighting. So this is not rocket science. And if you look at the PPO, my preferred momentum indicator, keep it along with the RSI. If you don't have a PPO, you can put up a MACD. It's very, very close cousin. When you put up the histogram, see, I can see it visually. I see the PPO line, the blue line, curling down, now turning down. It just peaked, poised to make a bearish crossover. Anything's possible, but it doesn't take an expert market technician to see this big green hill, each bar getting smaller and smaller. That means the momentum is waning. And then ultimately you cross, and you have a bearish crossover on the weekly. You don't get those often. Last time you had a bullish crossover was right here. Gave you that. Last big green hill, we had a big green hill there. We had a bearish crossover right there. That was a multi-month correction right there, double digit. Doesn't look like a lot because the scaling of, the move in the NASDAQ. There was a bearish crossover right there that came after a divergent high. That's when you really want to focus on these after divergent highs. Otherwise, you can get just crossovers within a trend. You also want to stay away from the bullish and bearish crossovers when the market's grinding around in a mostly sideways or low volatility range. But when you see these clean, trends, downtrends, a very clear, unmistakable downtrend, especially the powerful ones, downtrend. You want to look for the bullish crossovers. That usually signals trend change indicator, and it has so far. So we're looking at that. I just wanted to point that out because I could see as I flipped over to this weekly chart, PPO is poised to make a bearish crossover. And then from a bigger term perspective as well, or a longer term on this weekly chart, this is a key low. The October 2022 lows was a very pivotal moment in the markets, and tech and S&P, a lot of things bottom there. And you had a primary uptrend line, which was broken back here. And back then I had long-term targets, which I still very much maintain in the S&P 500, NASDAQ 100. I figured that had the likelihood to be a significant market top. And I still do. However, technically, we made a marginal new high. But with this PPO, if this starts to play out, all I'm looking at here, again, the primary uptrend line was broken. He went down, that's one single leg if you're looking at it from a wave count. Another powerful wave up, took us up a bit higher than I expected. But if we get rejected off that trend line, all that is a breakdown, back test. And that could take us down to those deeper targets. Again, on the NASDAQ 100, I don't have them here on XLK, but I've shared them many times on SPY and QQQ. So I think I already have an alert there. I'm pretty sure I do. I'm going to set another one. That's a big level to watch. If you just want to set an alert, sit back, whether it's 2 days or 2 months from now when that level breaks, that will most likely. You have a big old void here in the volume price histogram. What that means is there were very few trades. That was a very quick move up. Few people traded in it. You can tell my volume price histogram bars are turned off, but this is how far out they go, and they're very short right here, meaning that thin zone is likely to be filled pretty quickly. A swift move down that if you're not positioned for in advance or right when it happens, you'll probably miss that move, and then they'll probably come in and buy it there. And then if and when that breaks, that's even going to be a bigger sell signal. All right, let's move on a little faster. Financials, let me go back. Oh, yeah, I'm on the daily chart. I know there's a lot of lines. These are what I call busy boards, but you have that key low back in April. You have a nice clean up trend line, especially recently coming in very well defined, lots of reactions. And as mentioned on Friday, we had a breakdown in the financials, a big red candle, bearish engulfing candle as well, meaning this red candle, the body of it, the fat part, engulfed the previous 1, 2, 3, 4, 5, 6, 7, 8, 9. It took out 9 previous candles. And so far, we're still below that. We just need to punch down below and make a solid close below that $53 level to open the door to more selling. But again, this is the second largest sector in the S&P 500 at a weighting of now 13.7%. And so although it only moves a needle about a third, a little less than a third of what the tech sector does, it does matter. And of course, these are the financials, your big banks, even the big dog, the JP Morgan is broken below this uptrend line right there. Printed a small close below it on Friday, trading below it now. Visa, which is an active short, we shorted Visa way back here. We hit this was my first target was hit there. My second target was hit there. Third target was hit again. And I still maintain these deeper targets there. And this is also in my things to watch list. It's a tell on the economy, on the consumer. I'm seeing default rates go up. I've talked about that, especially on the low-end consumer. You look at the car retailers, those that handle their paper. You can see, and again, you can go to the Federal Reserve site, Fred, and see the default rates on and people, how far behind they are on credit card payments, and all that good stuff is on there. So we're seeing the economy roll. It's just been a very slow roll, and it has to do a lot with the job market. So either way, I just want to mention that's a big one in the financial sector. And, not enough time in this video, but I can go through there and tell you I'm seeing a lot of sell signals recently on there. There's Bank of America broke down on Friday below the trend line there. Berkshire broke down today. And so this is a sector, and I believe I mentioned this in the comments section today, very much keeping an eye on this sector here. All right, you can kind of see the charts as I click through it. Next up, the third largest sector now is the consumer discretionary sector, coming in at about 11% weighting in the S&P 500. This I haven't updated in a long time, but just to give you an idea what's in that sector, again, Amazon, Tesla, right? So most people consider those tech stocks, but yet they're in this consumer discretionary sector because that's what it is. Tesla makes cars, although obviously, tech-ish, if you will. Same with Amazon. Started out as online retailer, but again, they're selling things, so it's more dependent on the consumer and the economy. Just a beautiful bearish rising wedges. We've been walking up this wedge for a while. The trend line's very well defined off the April lows. And that's it. And remember, divergence, is just like overbought, is not a sell signal. It's a condition, just like we had divergence here. And at the time, we were watching this trend line here. There was the uptrend line. And that divergence didn't matter until it did. When did it matter? When the trend line broke. That marked a high, a top, put a top in the consumer discretionary sector, back tested at a secondary trend line. That was taken out. And then the bottom fell out. And from high to low, that sector, again, third largest in the S&P 500, fell about 28%. We've come full circle here, but we don't have any sell signals. This is clearly in an uptrend with a sell signal to come on a break below the rising wedge pattern, which is that uptrend line, which again, I believe I have an alert, but as I always say, you can't have too many. Nor do you want to create a parallel trend line. You want to click on set alert. There it is. Okay. And the way it works, one day I'll be sitting here and not expecting anything, or maybe there'll be a big market moving, economic report or earnings or something else. But if all of a sudden I start having alerts go off like popcorn, and I look and they're all, on the major sectors and the key stocks in the S&P, then that gives me a high degree of confidence and tells us sometimes to jump in and engage quickly. Because if more things that break down, the more likely both man and machine, meaning humans and program trading programs, are likely to see those breakdowns, and they will act fast, especially the machines. So There's just a lot of hot air built up in this market. It seems invincible and bulletproof, and I've traded many, many markets over the years. Sometimes they seem like they'll never stop dropping in a bear market or correction. Think earlier this year, and then all of a sudden one day it just does, and the next thing you know, we have an explosive rally to the upside. And then sometimes it'll seem like the market just will not stop going up and will never stop going up until one day it just does. And that day, that's what we're here for. Well, we can't tell you with 100% certainty, but the more of these trend lines that are well defined and chart patterns that say things are most likely going to turn soon, the more sell signals you get, the more likely they are to stick and end up being the start of a much larger drop. And again, you can see targets. We have initial targets. You're still above the 200s. You can't get too long-term bearish until the market in most sectors is clearly trading below their 200. So right now, again, where I started the video, that 60-minute chart at QQQ, first things first. Let's see if we can get to some of those deeper targets. And then if so, when we start testing or taking out the 200s, then I'll turn my focus to the longer-term targets. XLC communication sector is now the fourth largest at 10.5% of the S&P 500. So it still very much matters. Again, I haven't updated the holdings here that in a while, but Meta and Alphabet, they're still in there. Just the percentages have changed. So Meta, Alphabet, Verizon, T-Mobile, and I think T-Mobile's the one I highlighted for you before. I'm watching that. T-Mobile's coming up on a key, very important uptrend line right there. And like so many other stocks, already peaked. It's on its own little, this thing peaked back in the beginning of the year. It's been walking lower, but it's right now I wanted to highlight it. It's been on my radar. It's currently testing the 200-day simple moving average with the 200 exponential just below. It had a brief stint below them here and recovered. But it's also, if it takes those out, it's going to take out that primary uptrend line. And again, that's one of the largest in the communication sector, is why I wanted to point it out. Okay, so we need to take that trend line out there. XLV healthcare coming in at 9%, still, enough to move the needle. But this was one of the more bullish looking sectors recently. In fact, in one of the videos back here, I highlighted, put in a divergent low, and I'll give you 1, 2, 3, a total of 4 targets. But I'm going to point out it's been struggling with T3 lately. I also mentioned this in the comments section today, in my reply to one of those posts from the post this morning, that it's currently testing the 200-day moving averages and that the T3 level I gave you before. So I'm not so confident it's going to hit T4 right now. To do so, it's going to have to take out the 200s. Then that might be a little more bullish. But it took him out here for just a bit. And when it did so, it had negative divergence. Then it broke down below that wedge, back tested the 200s and lost them for good. And you can see what happens. So, yeah, longer term, most of the charts are telling me the same thing when I go longer term. A lot of sectors, almost all of the big sectors, have put in or coming off, and I've already either put in or a while ago, earlier this year, maybe even last year, big divergent highs have been moving lower and or have just more recently. And again, this is healthcare. You got to put that weighting, keep that weighting in mind, about 9% weighting right now. Then we get down to industrials and 8.36% weighting now. And again, I've noticed that where those top 3, the big techish sectors, again, technology, discretionary, and communications, where they all gained, even the financials gained 1% or so. The top sectors got even bigger in the S&P over last year, and these, when you go down the line, the smaller sectors got even smaller. So I'll cover them if you want to trade them, like energy, but energy doesn't matter. It can go to the moon and back tomorrow. It's not going to move the needle on the S&P. It's just the weighting's too small now. So industrial is about 8.36, so still relevant, certainly. And to me, the best I can tell you, just put in the first divergent high, negative divergence, since right here. Last time I put in a divergent high on the daily chart, that was followed by a drop of about 22%. Of course, you needed the sell signal, which came right there. There was your sell signal below the uptrend line, similar. This time around, the pattern I have, it's comparable negative divergence there. But you have this ascending broadening wedge pattern. I think that's going to need to go to do the trick. And then even better right here, that 144.44-ish level right there. See, that's your previous all-time high, followed by a big reaction off it. Then we consolidated for a while right here, broke above it. So if 144 goes with conviction, then that means that whole breakout, this whole thing, breakout to new highs failed. And that's technically a very bearish technical event when you have a failed breakout. So first level, second level, then the 200-day moving averages. And then wouldn't surprise me in the least to come down to maybe some of these bigger targets. I don't have this chart fully marked up. Of course, if you want any of these, if you want to trade a sector ETF or engage a sector and you want, a chart with targets, just let me know. I'll be glad to do that. I do this mainly to kind of get as I said in the beginning of the video, an index is simply a sum of its parts. And in this case, you can either do all 500 stocks or the 11 sectors, and then just keep an eye on a focus on the weightings. So now as we get down to consumer staples, 5.2% weighting. Staples are things you need. Think toilet paper, toothpaste. Those are your consumer staples. Things get ugly in a recession. People lose their job. They're still going to buy those things. It's the discretionary that's so high. Those are things you want versus things that you need in staples. So that's the difference there. And you can see we have a near triple top pattern there. Triple top high. I don't know where my lines went, but there's your divergence. So any equal or marginal new high anytime soon, anytime soon, equal or marginal new high will be guaranteed to be a divergent high. It's simply an extension. So we're looking at roughly a triple top, 1, 2, 3. And again, this is just bouncing around this range. It's noise. And so my guess, just like gold, there's a trading range. It broke out based on the technical posture. Those breakouts with divergences and overbought conditions, more often than not, which is not always, but it's just more often than not, probabilities say that breakout will most likely fail if it breaks to the upside. However, if you break to the downside, you have an uptrend line off the lows, and that would probably take it lower. XLE energy now has dropped down to below 3%, 2.91. As of the end of last week or so. And those are the most recent numbers. I just updated them today. I don't know. There's not a whole lot to say. Energy's just going sideways. It's a dead money trade for a while. I don't have much of an opinion on it. If you feel free to bump me on individual stocks within there. But you have such a, eclectic mix of different energy companies in XLE. It's trade that one kind of stock specific. It's my preference. XLU utilities, again at 2.3%, it's not going to move the needle, but I can tell you, put in a divergent high there. Utilities have been up, had a good year with all the hype behind them, both real and maybe overdone about all the the energy demands from all the AI chips that are so energy extensive. And so whatever, just from a technical perspective, the RR looks like shit to me. Honestly, it looks, to go long or stay long. This is a big divergent high. It doesn't say DH there, but you can see my divergence lines. And the last divergent high we had right there. And probably for the same reasons, this whole AI bubbles, it's nothing new. I'm sure the same talk was back there. And then the divergences played out and the utilities dropped 32%. The only other time on the nope, that wasn't even a divergent high. We had divergence, and that was at just made ever so slightly higher, roughly equal. But we did have a nice clean up trend line. And again, we were building divergence, had a blow off top, and then a big drop right there. That was when COVID hit. All right, so again, these guys don't matter for the market as much, but if you're interested in the charts, this is XLRE, the real estate sector, only now makes up about just under 2% of the S&P 500. And again, it's a sector that has long since peaked, put in a divergent low here. It's been moving up, but it's just a go for years. It's gone nowhere. So these are just better individual. If there's an individual REIT you want, or yeah, I can't even give you. You can see my levels on this chart. I'd have to sharpen my pencil and maybe add some new ones if you're interested in trading this one or IYR. I prefer when I'm trading at IYR and even charting the REIT sector because it's been around longer. But I just use XLRE because it's the spiders, the SP version, Standard & Poor's version of the REIT sector. So I assume that's going to match better the REIT component of the S&P 500, the Standard & Poor's 500. But again, you can't go back as far in time because they only started this sucker here back in 2015, where IYR, I was trading that one back in the financial crash, the Great Recession and all that, and having a field day trading that thing. So that's what I just wanted to mention. That's my preferred trading proxy there, just because it's been around longer. XLB, last sector, again, it's not going to move the needle. 1.88%, the lowest weighted sector in the S&P 500. There's maybe some divergence building there. I just don't have much of an opinion. It's not a better fish to fry right now, in my opinion. All right, that's it. Before we wrap up, let me just real quickly go to TLT. Let me go to TYX, the 30-year yield. All right, so you remember back on when the Fed started the last rate cutting campaign, we know with almost near certainty we're about to begin the next meeting. It's priced in virtually near certainty. The Fed's going to cut. Now it's a matter of, I just told you in the beginning of the video, there's some inflation data coming out this week that is either going to increase the chances. The Fed is going to maybe even, I don't know what the talk is now, of a 50 basis point cut. Or the dot plot going forward. See, the market's going to hang on that. We know we've got a 25 basis point rate cut baked in the cake at least. And but again, what happened last time is, and the first time, at least in modern history, at least that I can remember, where the Fed completely lost control of the bond markets, I highlighted then. They came in with not just the usual 25, but a 50 basis point cut on September 18th, which is typically or historically, those have been reserved for times of financial distress, like the financial crisis or something, a problem with a bank failing or a big bank or something along those lines. And instead of rates going down, like most except us thought, we went long, short treasuries and long yields based on the charts. The technicals told me that, yeah, things were going to go the other way, even though, most of the bobbleheads on TV said, oh, the Fed's going to cut rates. It's going to take, the federal funds rate. It's going to take the, all the interest rates down, 5-year, 10-year, 30-year bond, which usually happens when the Fed's on a rate cutting cycle. But the exact opposite happened. Rates went the other way, and it wasn't just a one-off event. The Fed followed up with another 25 basis point cut at the next meeting, and rates went up from there. They abated a little bit after that spike, but then continued to climb into the next meeting, and the Fed followed up with a third rate cut. Then they backed off. They hit the ruh-roh button. Uh-oh, something's going on here. We keep cutting rates, but the long bond keeps going up. And that was the bond vigilantes coming in and checking the Fed, saying, all right, you keep cutting rates and giving this easy money back to the markets, you're going to reignite inflation. Well, so the bond market checked the Fed. The Fed cowed down, stopped their rate cutting cycle, and okay, everything kind of returned to normal, right? And the bond market settled down. Now we have a near certainty of an upcoming Fed cut. Now I want to just bring this to you here. Back then, the market, like now, you can see this really did it last week when we had that weak jobs report, right? And, the yields just have come down sharply since then because it locked in the Fed rate cut. So the market's doing what they were doing back then before, heading into it. It did the same thing back then. The rate cut, as soon as the market was pricing it in as a near certainty, the 30-year was falling. But once the Fed actually cut, and that's when rates started going up. So just guys, I don't know if it's going to repeat that pattern. All I'm trying to say is don't read too much into this fact that the 30-year and the 10 and 5-year, they're all falling right now. I can tell you they've broken out when I look at a lot of things, and so that may continue this time. This is my TLT, flipping the yields upside down. You have the price of the 30-year, and this is my primary uptrend line or downtrend line. That just broke out. I have similar things happening on the 5-year yield. Let's see, FVX. Oops, yep, there it is. I had a triangle pattern we just broke down, but we're at support. I've been telling you for a while, we over the last couple of years until recently, I've been playing TLT like a grand piano. You know, I trading usually ZB is my preference, the 30-year Treasury bond futures. We've had a lot of trades, batting probably 800 or better on it. You know, a lot of successes. And lately I've been out of it, and I've told you, and I'll continue to watch them to see where they're going. But my degree of confidence for trading it isn't very high right now. But just kind of based on the charts, the noise, everything else. So I just wanted to kind of show you this chart and show you that we could see, unless these breakouts fail, we could see this time around, unlike last, longer term rates continue to fall. I'd rather just wait to see once the Fed's over, let the dust settle, and then we'll reassess the bond market. I'm going to continue to watch it for what it may mean to the economy and the markets. Don't get me wrong. I'm very eager to see, after the next Fed meeting, what rates do, what Powell says, how the market reacts to it, and of course, watching these inflation numbers coming through. Where we go with inflation from here, this has always been for years. If you follow me, I've used this to predict, and with a pretty good, accuracy rate of how the CPI reports are going to come in. What you're looking at here is just DJP, one of many, but the one that I've used for this purpose, a very diversified commodity ETN. It tracks, the Dow Jones, UBS commodity index, which is basically a basket of commodities. And housing is number one in the CPI. But crude oil and energy, I believe, is number two, and certainly matters. And that's a big, in all these broad-based commodity index ETFs, ETNs, that energy is the biggest component. So you can see what happened. This was the Fed in denial. This was COVID, excessive money printing. Everybody but the Fed knew that inflation was just rip roaring. Those, Powell and the other elites that probably don't even do their own grocery shopping or gas their own car up, were oblivious to that, and that was the denial and the Fed's big, inflation's transitory. Then they realized it wasn't just transitory. It took a while to, for them to see that. And again, for the data to show it. Remember, the data is going to be lagged. They take the CPI is calculated, read every month. The basket of goods and services around the country. However, they're using more and more imputed data now than they used to. And so when you impute during a falling, trend, and that's what we've had since COVID, it's going to tend to be, understate inflation. And so since things went crazy, we did have a real abatement. Energy prices came down, grains, food, all that stuff. But you can see we've been ticking up. This is where we troughed that abatement in inflation, at least when you're looking at commodity prices. And since then, it's clearly been moving up. So I'm not going to make a call this time around as to whether the numbers are going to go into hot or cold. Usually what I do is I look at the month. Remember, we're going to be reporting the month of August, and it's actually been a drop. Most of August was down. This is, where is it? Right here. There's the beginning of August right here. What I do, I take these little boxes and I box in. Actually, no. Where's August 1st? That's the end of July right here. So the box is something like this right now. And end of August is right here. August. So, overall, but most of the lift came in at the end of the month. And that's probably what you're looking at there. Yeah, so again, I flip a coin. I don't know where the numbers are going to come in. All I can tell you, if that imputed data finally starts to, click in that, yeah, we were, prices were falling for a while, commodity prices, but they troughed out here, clearly troughed out. and have been moving higher. That is every bit an uptrend, really, since this point here. This is where they started to move up. And so, anywho, we'll see. This will determine just how easy or not easy the Fed is going to be able to get going forward. Again, we're going to get whatever we get at this meeting. I think it's still 25. Sorry, I said yeah. So again, 25 basis points the most likely scenario. All right, guys, that's it. So we'll watch this, and then bigger picture. If this is a range where commodities have been in, again, a broad-based basket of commodities, this would just be that very, very much feared by some right now, not by equity traders and investors, but by some, that whole stagflation thing, where if we do get the stagnant growth, but yet rising commodity prices, you're looking at stagflation, stagnant economy with a rising or persistent inflation. All right, I'm going to stop the video here, get it out to you guys, and we'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great evening.